I think in the clean tech investment arena, I think the big issue is that as the venture capital community has discovered that a lot of clean tech companies are highly capital intensive businesses. They are to some extent retreating and looking for clean tech opportunities that have closer to the traditional software startup model, which are less capital intensive. I think that's for a couple of reasons. One is that when you look at some of the infrastructure clean tech businesses, such as in utility scale solar, wind power, that sort of thing, the dollar amounts needed there are staggering, and it doesn't make sense from an equity standpoint to support that. And equally important, the debt markets in many cases aren't willing to support that kind of activity for a number of reasons. One is the general economic changes in the last couple of years have made lenders much more conservative. But secondly, on the project finance side, in terms of building these plants, for the project finance bankers, their margins in these loans are not enough to assume the kind of risks that you have with a lot of these startup companies and their technologies. So for example, in terms of things relating to power production, if it's a technology that doesn't have a proven track record over a number of years, the bankers are inclined to shy away from that. So what has happened here, I think, in terms of investing over the last couple of years, is that the venture capital community, while their total dollars invested in clean tech has jumped dramatically, there has been a drop-off in investing in early stage companies, which shows a more conservative approach in terms of taking these kind of risks. And I think what we have seen in terms of some of the successes in the clean tech community, such as Tesla Motors and its IPO, is attributable to the fact that the government has stepped in and provided financing that the traditional sources could not and would not provide.